So thank you again, everyone. I'm here with Bryan Fischer, Managing Director at Crestline Investors. I want to start out with a short anecdote here. When we first started talking with Oval about this conference, I was very insistent. I wanted it to be about private credit and fund finance, which they were seemingly on board with. And then I saw the logo come out for the event. So you see private credit in giant big letters, and then fund finance in like 2-size font. But I think
that's probably where it belongs.
Well, I was going to say, the way this market is heading, I think next year we'll have that font size up to like 14, maybe.
Yeah.
So thank you again. So I think what we want to do here is talk a bit about the NAV loan market. There are a couple of things we could talk about in fund finance in terms of Goldman's securitization of a subline last year, interesting stuff like that. But I thought the NAV loan space, at least for me, is the most interesting. So Bryan, why don't we start out by just defining what a NAV loan is, because I don't think the market this is widely known concept at this point.
Yeah, I mean, we've come into a lot more forefront since COVID, I think, especially on the PE fund NAV. But, NAV lending's been around for a long time. The credit fund NAV or secondaries NAV, where people are using it for systemic leverage and helping enhance returns across a hyper-diversified portfolio, has been around for 20 plus years. We got in this business doing particularly single fund NAV about 10 years ago. And, what we saw this opportunity where funds are past their investment period. They're mostly out of dry powder, but there are additional opportunities inside the portfolio that they can take advantage of. And there was a hole and not very many people providing this capital of just accretive, accelerating capital they can use to continue to fund those investments at a reasonable rate of return. And, we looked at it and said we thought this was, really good, risk-adjusted return for us on the private credit side.
Yeah, so ultimately, it's either a loan made to a secondary fund on the net asset value of its various fund interests and other primary funds, or it's a loan made to a primary fund on the net asset value that has in its various portfolio companies. So that's kind of when people talk about secondary NAV or primary NAV, that's the general difference, just so people understand. And what it is not asset-based finance, which is something we talked a lot about at FFA. These are not leverage facilities with eligibility criteria or concentration limits like that. It's a much different beast. So I guess what would be the typical fund borrower that you would work with? It was interesting because I read an article recently on LinkedIn where they said the question for most fund managers is subline versus NAV, which I think is an entirely wrong question to ask. It's usually they're in different life cycles when they're using these products. So talk a little bit about that.
Yeah, I mean, the subline versus NAV, they're inherently two different things just for two different parts of your fund life, right? The subline's looking up to your LPs and your investors, and the credit quality of those LPs and investors, and the NAV loan is inherently looking down at the quality and diversification of the equity that you have in that fund itself. Typically, it is... For Crestline, across a wide variety of assets, we probably have the largest aperture for what we do. A lot of the capital that's been raised in the last few years has really focused on kind of top 500 PE fund NAV. We'll look at venture capital, hedge funds, family offices, infrastructure, real estate, kind of across the gambit. And that's really a benefit of us being in business for 10 years and having done dozens and dozens of transactions and have dozens of realizations, so that our investors are pretty comfortable that we can get comfortable with a wide variety of both assets and asset types and geographies.
Great. And I guess what would be the typical use case for most of these borrowers? Because I think there's been a lot of content put out about that, and maybe some misinformation.
We're going to get into the dirty distribution trade.
I promised Doug we would get a little spicy here, so we can do it.
I really break it up into three main categories. When NAV first started, it was really the defensive uses that people were going to. It was, we have an over-levered business, and the banks in a restructuring and amendment is requiring us to bring some more equity to the table that we just don't have. But we believe in this business and want to save it. So using a NAV loan for that. The accretive uses are pretty obvious. You have a bolt-on to do. You have a new platform that you want to put into this fund, and you haven't raised your next fund yet, so you need some additional investment capacity. These are really solid, easily explainable to your LPs, and you can sell them on the fact that they're getting a real return on those dollars. And then the third one being, I look at it more as portfolio management. So that's either a GP Manco type facility where the GP is going to use it to help either fund additional equity into a continuation vehicle that they don't necessarily have, or they want to upsize their GP commit into the next fund that they're raising now because they believe that there's great returns that they have. And then the last part of that portfolio management being the DPI trade or synthetic distribution. It's gotten pretty controversial. There's been a lot of pushback, especially from large LPs who kind of manage their own liquidity profile and use their own leverage. And especially as interest rates rose, they didn't want to be paying above the hurdle for their own distributions when they didn't necessarily need it. There's some nuance to that. Certainly around, where are you in the fund life? Is now a good time to try to force an exit to generate some return, or do you believe that there's some reasons to hold that for another 2, 3, 4 years, but your LPs could use some money now?
Yeah. And I guess, there's been a bunch of new participants in this market. How does Crestline differentiate itself versus other lenders in this space? And certainly with all the new participants that are theoretically in the market, I think there's something we can push on that.
Yeah, we try to differentiate ourselves a couple of ways. One, we've been in this market for a long time, and we run 2 separate pockets of capital. One kind of focus more on investment grade type credits. These are larger private equity funds with more diversified portfolios and lower loan to values. And that's really where a lot of the new entrants into the market have gone. And so that's, it's a great risk adjusted return. It's a very safe product. If you look at the history of returns on private equity, the number of funds that have returned less than a 0.5 is really, really low. And if you're in something early and you're out by a 0.5, it's a very safe return. And it's a large ultimate total addressable market. Inside of that for us, again, we'll go wider across real estate and infrastructure and venture and growth capital, and even doing some non-traditional fund structures or holding companies or family offices that a lot of our competitors won't do. Well, we also have run a separate pocket of capital that's more kind of opportunistic focused returns, where we'll do much tighter portfolios and look at 2, 3, 4, 5 asset portfolios where maybe there's some distress, where there's real gap risk, and you really have to spend the time and underwrite and do a heavy underwrite and get comfortable that there are good assets there that are going to ultimately return your dollars.
Cool. So let's talk about some of the spicy stuff in terms of the ILPA feedback and content. And I want to level set for the group in the audience here, just to give people an idea of why this was a point of theoretical contention. So the LP community, a couple of years ago, I think, woke up to the fact that NAVs were being used. And the reason why I think they had issues with it was because a lot of the NAVs are done outside of the main fund level, within SPVs, typically below the main fund, where we actually move assets from the main fund over to that SPV, and that's what gets financed. Oftentimes, that's being done outside of the main fund limitations and the main fund LPA, for the debt limitations, I should say. So that was the first thing that kind of woke up, I think, the LP community to the fact that we're using structures to get around high-level debt limitations. So ILPA, I think, was last summer, put out, which is the Institutional Investors Trade Association, essentially. They put out some content about the NAV loan product, and essentially the gist of it was more disclosure would be helpful. LPAC consent sometimes required, although that one I kind of pushed on with our investment funds group, who are part of that process. So maybe talk a little bit about kind of what you've been hearing about that and kind of your views and all that.
Yeah, I mean, it's really an issue of potential misalignment. As I talked about before, if you don't feel like you need the liquidity, you want a voice. What ILPA ultimately said was really what all of what we were doing at Crestline and all of our NAV lending peers were already doing, which was making sure that your LPs were on board and understood that you were doing this trade. And I think that's the key. And I've been on multiple panels with ILPA, and they stress communication is the key. And until we get the fund docs to where they really truly contemplate NAV, we just have this long period where this is a fairly new product, especially for, private equity single fund NAV, where the LPAs just were not addressing this. And so having that communication, I mean, ultimately, if you're levering someone's equity, you should be able to explain to them why and why it's a good idea. And if you're not willing to have that conversation, we weren't really willing to get into that trade. In fact, we've lost more trades, not to competitors, but to LPs saying, well, I'll just do that deal. That's a great deal. We like that trade. And so they see the use cases, and especially if you're saving a portfolio company or you're doing a roll up and you need some more equity, they totally understand that. And if you have good reasons why a DPI trade makes sense for them, or they're coming to you and saying, we want liquidity, then, and this is why, or we have an LP was an oil and gas investor and they're getting out of the space and they want to trade out of this position. And they've come to us and said that they've got a bid at 65. And, we believe in our NAV. We think we have good businesses. And so can we use the fund to buy that NAV back? And then that benefits all the other LPs with the value accretion from that trade. So there are lots of nuanced ways that this conversation should go, but really it's one that the GPs should be having. And if they're not willing to have it, it's not a trade that most of our peers want to do.
Yeah, this is really lame, but in law school, I think Judge Learned Hand wrote in one of his opinions, sunlight is the best disinfectant. And the more disclosure and the more information that gets out there about how these products are used, the more LPs get educated about it, the more they can make a decision of, I like how this manager is using the product and I want to roll into the next fund with them, or I don't like it and I'm going to vote in my feet and not roll into the next fund.
Yeah, exactly. And look, this has been a very quiet market, for the longest time, really until COVID. The deals that we were doing were these more kind of defensive distress situations. And GPs would tell their LPs, but they didn't want to tell the market that they were doing these. They thought it made them look weak-handed. And this is really just another point of leverage in a different spot. You're levered up here. There are great reasons to do it. If I looked at a DPI trade in the last 12 months where the GP ultimately didn't do it, but instead he did a holdco pick at the best asset and took that asset up to 6.5 times levered at 600 basis points wider than where we were discussing a NAV trade. And he says to me, well, I didn't have to talk to my LPs.
Yeah.
And, the more that these DPI trades, especially the high profile ones, work out or don't, and the more we talk about what we do and how we do it in the market, ultimately it is just a point of leverage, not inherently good or bad. It's how you use it and why and what your investors think about it.
Yeah, I have two reactions to that. Number one, I analogize this to the LP community reaction to the subline product, a decade plus ago, right? Where the initial reaction was, why are you putting leverage on this fund? What's the need for that? And then eventually, oh, you're gaming IRR to a certain extent by using a subline. But at this point now, it's essentially just a vanilla accepted part of a fund's life cycle. And I really do think NAVs are going to get there where there's going to be part of the GP toolkit and just part of what they use in the ordinary course. So I guess where is the NAV market going from here? We're just at 4 font size right now, but maybe we'll get up to 10, 14 next year. But what are your thoughts?
It's going to get huge. No, I think, we have all the tailwinds and we do have the benefit of being able to look back. And if you look, if you think generally our loans are being used past an investment period, you take a 5-year look back and you start looking at, how much captive equity is even in just the private equity market, and then compare growth rates to either sublines or you compare it to, the growth in the secondaries market. There's lots of reasons to say, we're at somewhere in the, 100 billion outstanding range, I think. And if you just think about PE, that can double or triple easily by 2030, just with the compounding captive equity that's going to be there. For us, my partner Dave's about to put out a white paper because we also do, real assets and real estate and venture. And then you add in, how massively huge the family office market has gotten. And I think our product is actually a fantastic fit for family offices. The best thing about a NAV loan is its flexibility. You can do multiple things at once. So you can help that refi out that company, or even if it's a troubled company and you like it, pull all of that leverage up a level and let that company settle down so it's not just getting killed by its debt load. You can do an add-on and potentially do a distribution and do those all at the same time and solve multiple portfolio problems you have. And in a family office, that's especially acute, where you have a book of privates that's potentially not paying for itself, but you also have, unlevered real estate and an operating business and some fixed income that a lot of people just don't really have the wherewithal to underwrite. And what we do is generally a pretty simple piece of paper. There's obviously some nuance to it, but we're writing a term loan with potentially a DDTL, and there's going to be a couple of covenants in there, and we allow recycling and all sorts of stuff. So it's a really, really flexible piece of paper that people, just the usage rate continues to increase, and I see that going forward pretty massively. And then if you want to go like crazy, I've heard some of our peers say, well, a private equity fund is just going to try essentially what a holding company sometimes does, where you have disparate assets that you're running separately. Maybe you have a revolver down there to just handle working capital, and just because of the flexibility, just run all of your leverage up at the top level and just run it kind of much more fungible. And if people start doing that, then sky's the limit, right?
I think you threw out $1 trillion by 2030. Was that the goal?
It's somewhere like that.
Okay.
Yeah. It's a bold claim, but
no,
we interact with the secondaries world, and you have to compete with Mr. Robar from Dawson on bombasticness.
I mean, private credit, though, like 5-6 years ago, people were saying $3 trillion in a couple of years, so I don't think it's so crazy. I guess, what about family office NAVs? That's kind of a nascent area that we were talking about.
Yeah, I mean, just as I mentioned, I mean, it's I think the projections for 2030 on family office NAV is 5.4 trillion. And again, I just think our product is a very natural fit. It's also like all of those issues that we talked about around alignment don't exist. Oftentimes it's the vast majority of the capital that the family has. And so for us, from a risk perspective, we think it's very attractive. You get multi-asset class diversification. You have an aligned trade with somebody, and generally it's someone who's been successful and is sophisticated about how they go about investing as well.
Cool. So we didn't chat about it beforehand, but I'd be interested in your thoughts on the collateral security package. And because I know that's a point of contention with a lot of sponsors, and the way I view it, a lot of private credit funds have kind of come over to the fact that a lot of the sponsors require collateral light deals or security light deals, where essentially all you're getting is a pledge of an economic stream of rights, maybe DACAs where all the distributions are flowing from, but you're not getting actually pledges of any of the holding companies that ultimately own the asset. And just for the group's benefit, the reason the way the market has evolved this way is at the asset level, there are often restrictions on the upper tier pledges and transfers. So that's essentially, and then there are ramifications if you breach those provisions. So lenders in the space have kind of gotten comfortable with collateral light packages where you're not actually pledging voting control, but you're ensuring that the economic rights and distributions related to the underlying investments ultimately get to the right place at the end of the day. But this is like a new area, and we've never really seen like a true down cycle here yet. So that's kind of the one area I'm always interested in seeing how lenders view how this would work in like a true down cycle and all that.
Yeah, I mean, I'd say a couple of things. One, I think it helps the growth of our market, because the number one fear of a GP is that we're going to take over their fund, and there's substantial. I mean, if we were to go in and foreclose on a fund, the franchise risk for those GPs is massive. They likely never raise a fund again. And so it's always been the number one fear. So I think on some levels it was naturally going that way. I think the flood of insurance capital into this space helps that. They need ratings. Ratings are really a gauge of risk of default on the methodologies that they have. And so if you have less covenants and bigger LTV space and more tenor and standstills, they can get comfortable there. At the end of the day, when we're providing, it's a partnership. We're providing leverage to a GP that we believe is going to use our money in the right way. We have absolutely no interest in taking over a fund. and they're the best stewards of that capital. The LPs also chose them to be stewards of that capital. And so in the situations, and we've done dozens of trades, and they haven't all gone perfectly, but you sit there and you work with the GP, and so I think that's why you've seen, especially on the higher quality sponsors, those deals make all the sense in the world to largely be unsecured. On the other end, when it's a much tighter portfolio and the gap risk is absolutely there. I mean, we're all talking about, there's underlying leverage across all of these things. When the gap risk is absolutely there and there might be action that needs to be taken, that I think we'll see the larger end, lower cost end of the markets be unsecured, and it largely is at this point already. But I think on the other end, there will still stay. I mean, it's a very structured, very bespoke structured market, depending on the assets themselves and the LPAs and the performance, et cetera.
Yeah. I mean, the LTVs are pretty low for these products. Like a buyout fund, we're talking 15 to 30%, right? Maybe up to 40%, depending on the manager. For a venture fund, like 5 to 10% max. So that's ultimately why, I think this is really an actual vanilla product at the end of the day. Although I think when people initially hear no collateral and all this stuff, they freak out a little bit.
But even at those low LTVs, if you do a look through analysis, it does end up being a pretty low attachment point. A lot of times, kind of in that 60 to 80% range attachment point, just with the leverage that's up top above it. So again, that's something that is there is gap risk there. And then I will say as well, the restructuring people were talking about PIK. Almost all the loans that we do are 100% picking, simply because rarely are people on a buyout fund sending quarterly distributions up, and so we're aligned, providing people bridge capital to that exit that they're trying to have, to that big liquidity event to ultimately pay us off or de-risk us in some way.
So, existential question: why do people not like NAVs for distributions, but they're okay with dividend recap transactions?
Well, I mean, the answer you always get is that's because that's how we've always done it.
Just because people have done it before?
Dividend recaps, normal course of business. I mean, the other kind of funny part about it, and we talked a little bit about this, is that especially on the larger end of the market, almost everyone, not only is it unsecured, but almost everyone demands some kind of cash split or cash sweep holiday, where for the first year or two you're not, depending on various things, you're letting money leak out of the system when a liquidity event happens. And so LP's very upset if you're, or not upset, but against that kind of distribution on the front end. But if they do a trade where they use it for accretive purposes and then 6 months later sell an asset, they're perfectly fine being in that levered vehicle. Yeah. So just a little bit of a conundrum, which again I think is why somewhat this conversation is still evolving. And if we go another 9 months here, the crazy equity market today, if we go another 9 to 12 months without distributions, and now you're talking about a 2020 fund that is still at a 0.2 DPI, does the LP conversation there change as well, right? Because likely, I mean, think if you had a 2020 manufacturing and distribution focused fund, you've dealt with COVID, supply chain issues, rising interest rates, and inflation, and now you're dealing with tariffs. Like, for those types of businesses, I mean, you want 12 to 18 months of growth before you sell it. So you're already talking about 26, 27 before they're really going to start generating meaningful DPI out of their portfolio.
Yeah, I think LPs might come around to that point.
It's a much different trade when you talk to venture capital funds and real estate funds who have had a tough exit market now for 6-7 years. Like the LPs are much more interested in liquidity from those portfolios than a buyout manager.
Great. Any other topics you want to hit before we go to the Q&A?
No, just fire away.
All right. Any questions from the audience?
What's the pricing range on these NAV loans?
The question was, what's the pricing range on NAV loans?
Yeah, I mean, it ultimately ends up kind of sitting in two different buckets. Kind of the investment grade stuff's anywhere from kind of 400, 425 over to 600, 650. Kind of looks a lot like the direct lending type returns. And then on the other side, hyper concentrated portfolios, with deeper LTVs and maybe some performance issues. I mean, that stuff can be anywhere from 900 over way up. I mean, we've had some stuff that's very high yielding, but you're taking real equity risk there.
So if, say, you're lending to a buyout fund and several of the portfolio companies kind of go belly up, how do you underwrite the NAV loan to make sure that you as the NAV lender have your downside protected?
Yeah, so we spend a lot of time thinking about kind of a couple of things. One, what's the actual V that is there, and what's the stability of that V? And so almost always in an 8-asset portfolio, you'll see 2 or 3, they're going to be 40% of the NAV. And, we will spend a lot of time on those 2 or 3 assets to get ourselves very comfortable that anchor collateral stability of V is there, and we're well protected, in those assets, and have a lot of confidence in the performance of those assets. And then again, it just goes back to why those LTVs are so low. Because if you do have 2 or 3 if you're in an 8-asset portfolio, I mean, you should, in theory, still be fine.
Yeah, my answer is going to be LTV, period, full stop.
And what's the typical duration of one of the NAV loan funds themselves? Are they closer to 10, 12-year PE fund lives, or are they kind of like shorter credit fund lives?
For our funds?
Exactly, yeah.
Yeah, I mean, we raise typical 5-year funds, 3-year investment period. And we're writing 3 to 5-year term notes. And like I said, we've had dozens of full realizations. Average life of a NAV loan's a little over 2.5.
Thanks.
Seems like, oh no.
Hey, thanks. 2 questions. The first on a weighted average life of 2.5 years. Is that self-amortizing? Is that how you guys structure your loans? Or is it more like maturity?
Yeah, maturity. We just do a bullet.
Got it. And then maybe on the insurance sort of PE NAV, like do you guys do work around sort of bond definition or not necessarily so?
No.
Thank you.
Thank you. So my understanding is a lot of the solutions are bespoke today as it comes to the negotiation. As the market continues to evolve, do you see any terms that you would expect to kind of become more standardized across different deal profiles, or how do you see the evolution of terms kind of in the market as it continues to grow?
I mean, I think there's generally some standardization around kind of the main topics being, or main covenants being, a diversification covenant and a maximum loan to value covenant. Those are kind of the two. The devil's always in the details, and I think every fund formation group has been fighting standardization of LPAs, and so as long as those LPAs aren't standardized, they're still going, and structures look differently. There's still a lot of kind of sausage to be made. But I think those general terms, and then some of the things around cash sweep language, especially on the larger deals, those all are pretty standard at this point. They're just a little bit of margin based on kind of the asset type and ultimate diversification that you have.
Any other questions?
All right. Looks like we people want to get to drinks. Thank you, everybody. Thanks, Bryan.
Thanks, Ryan. Thanks, DLA.